Welcome back, traders and investors. It's time to talk a little bit of market structure here with Christopher Nagy and Dave Lauer of the Core Group, King of Retail. Chris is the founder and CEO of the group, a 25-year veteran of Wall Street. Dave is president and managing director of Core. Guys, how you doing this morning?
Doing great.
Doing great. Thanks for having us on.
So guys, obviously we've had a lot of talk here lately on high-frequency trading. We've had the New York State Attorney General, Eric Schneiderman. He's now targeting high-frequency trading. In a recent speech, he cited advantages that high-frequency traders have, including co-location, early access to market-moving information. He referenced one large high-frequency trading firm, which obviously is Virtue, as having only one losing day in the last 4 years. Now you're seeing a lot of talk on Twitter. You're seeing a lot of talk from the media saying that if you've only had one loss and losing day in the last 4 years, you must be having some significant advantages, because how is that possible? Now, for my own personal trading, I'm a little bit not on board with that, because I know market makers back in the day had a lot of days where they didn't lose money. What are your guys' thoughts here? Do the high-frequency traders, do they have some significant advantages over here, or are they just getting paid to provide liquidity?
Yeah, it's a great question, and I think it's something a lot of people are focused on, because sometimes something like that sounds maybe too good to be true. I have to agree with you, Dennis, that it's probably the wrong thing to focus on. I think when you're talking about a market maker that's diversified over 10,000 products on a daily basis, and you can even have a reasonably low win rate. You can have like a 53% win rate, and still it can be shown that you won't have a losing trading day for years. So it doesn't seem like that is a symptom of something to be concerned about. I agree that there are market structure issues, obviously, and I agree that there's reason to be concerned about things that are going on in the data centers, and to have some concerns around the way data feeds are distributed, for example. But I don't think that this is something that is honestly that big of a deal.
What do you think is? Go ahead, Chris.
Oh, sorry. I was just going to say, one of the things that I think brings a lot of questions about is, back in the day, it didn't seem that the advantages you were talking about, Dennis, were so unfair as they appear today. So, for example, back in the day, everyone touted that we're a member of the NYSE, right? Where today it's a little bit more cloudy and murky to understand exactly what those advantages are. And the rule structure set just isn't very clear. So I think that's where the focus needs to be on the real issue.
Like you're thinking,
yeah, I totally agree.
Like more transparency maybe on some of these issues too.
Exactly.
Now, okay, so do you believe though that these HFT firms, because everybody's coming out and saying these guys have unfair advantages and the playing field isn't level, is Grandma, is she on a level playing field here, or is there some stuff that needs some improvement?
So I'll talk a little bit about Grandma. There was an article out yesterday.
Yeah, that's what I'm referring to, the Bloomberg piece there.
Yeah, that Bloomberg story that was out yesterday talking about, Grandma can be on the same playing field. And coming from the retail world, I'll tell you that nothing could be further from the truth. Grandma is not on the same playing field as the high-frequency trader, not even close to that at all. And while there are some firms out there, I know of a couple of firms that do offer co-location, you're still dealing with the latency of your location, and you're just not at the same level at all. Most of the big brokerage firms that are out there aren't even close to having co-location like a high-frequency trading firm.
Now, what other advantages here, Chris, are you concerned with? Like, obviously at Core, you guys are looking for more transparency, and you're looking into some other issues. What other advantages do you think that, how could we level the playing field a little bit more?
Dave, you want to take that?
Yeah. I think that especially from a retail perspective, we're really focused on a couple things like, again, transparency and disclosure around market quality and broker routing decisions. We're really focused on payment for order flow. I think that that's a really important issue that we're looking to confront. And then from a technology perspective, it's probably a difficult thing to solve. I think we need to be looking into ways to incentivize speed less and the price more. We need to be looking at some of the techniques that they use in the options markets over in equities, and we need to be looking at different techniques that they use around the world. Things like the trade at rule, which are good, which are done in Canada and Australia, might make a lot of sense here. So as you push more volume back onto the exchanges from the dark pools and the internalizers, I think you start to see the playing field even out a little on the exchanges. I think you see more different time scales in terms of trading strategies, a diversity of trading participants, which is what I think we're lacking right now in the domination of high frequency.
And that's a big thing that I've discussed here on the show here in the past is this diversity in the market participants. I'm always kind of looking at liquidity. And you can say when you take a snapshot in time and look at the NBBO at any given time, it looks like there's a lot of liquidity, especially on your S&P 500 stocks. But how much of that liquidity is made up of high frequency liquidity, which vanishes, obviously, we know, when the going gets tough? Do you think like it's the majority of our liquidity there?
Yeah, and I think that's something that when you're looking at the what the quote is and what the makeup of the quote volume is, that's 99% HFT. So even if HFT is only 50 to 60% of trading volume, that quote is 99%.
You think the quote is 99% HFT, and that's scary because obviously we saw on the May 6th flash crash, and it's not. I don't think it's about a matter of these guys coming and putting affirmative obligations on them and making them quote. I think it's more a matter of trying to get some more diversity in that quote. Getting traditional participants maybe to quote. Chris, how do we do that? How do we get more different types of participants to start providing liquidity?
Well, one of the big issues really that's evolved to the structure that we have today has been one of regulatory. So I'm sure you've spoken on your show quite a bit about this regulation NMS or National Market System. That was brought into place almost 7-8 years ago now. And really from the regulatory landscape, there's been near zero change with regulations. However, the structure itself has advanced much, much more than it has in the past 2 decades. So we're really behind the 8 ball in terms of that, and modernizing and updating a lot of those regulations so that we can have more transparency to understand what's going on, and then to create structures that bring back different and more kinds of liquidity are very important today. Also, to bring a lot of the practices of brokers executing orders off of the lit exchanges in dark pools, which has had a really big impact on overall liquidity, bringing that back into the transparent markets is a big issue. And getting the regulations up to date with that is going to be very important.
Yeah, it seems like our entire market here is starting to go dark. If you've looked at off-exchange trading levels over the course of the last 5 years, where were we, like 19, 20, 25% maybe 3-4 years ago, and now we're kicking up towards 40. And the CFA Institute, who I'm involved with, I'm on their Capital Markets Policy Council, they came out with, it was a study that I helped with too, actually. They came out with a study last year where they were looking at internalization and they were looking at payment for order flow, and they were analyzing off-exchange trading. And what they found in this study is that as off-exchange trading climbs to a level above 46%, that price discovery and spreads start to widen and price discovery starts to become impaired. On some individual stocks, especially some of your small caps, some of those individual levels are up. Like you'll see 1,000 or 2,000 different stocks that have levels of off-exchange trading above 60%. So on those stocks, it's basically saying that they're probably going to have wider spreads. So here we come now, and we're looking at, the SEC is looking at doing a tick size pilot here to try to encourage liquidity providers to come back into the small cap space. Will this tick size pilot, if we widen the spread, will that encourage new participants to come and start providing liquidity on some of these small cap stocks? Maybe I'll start with you, Dave.
Yeah, and I honestly just don't think so. I think that the tick size pilot kind of misses the point. And I'm just much more in favor of a trade at. I think that is a much more effective mechanism and sort of a more something that theoretically to me makes a lot more sense. If you're going to take something off the exchange, if you're going to impair price discovery, then there needs to be substantial compensation for that. I don't see a good argument against that.
Now,
I know
what
Chris
if you
has
were
a lot of thoughts on this?
And Joe Saluzzi, and I've actually been saying it too. What if you were to do the tick size pilot with a type of trade at? And just for our listeners who aren't familiar with the trade at rule, it's basically a rule that gives the displayed quote priority over the undisplayed quote. So if you're sitting there on your bid at $25 and somebody wants to sell to you at $25, your fill you'll get filled before the before the off exchange stuff gets filled. That's kind of in a nutshell what the trade at is trying to do. Now, this is just a concept. It isn't an actual rule, so we don't know how it would actually work. But that's something what they're doing in Canada and Australia. Do you think if they were to incorporate that trade at rule with the tick size pilot, would that be a better way to go about it?
Chris, you want to talk about this because
yeah, actually,
Chris has spent a lot of time
a
on
little bit. Yeah, so Dennis, I actually testified before Congress last July as part of the Jobs Act, which is part of this whole tick pilot. And in my testimony, I recommended the need for a trade ad. There was actually the final bill that was passed, which is H.R. 3448, is a much watered-down version. So there is a form of trade at in that bill, but essentially what it's doing is it's asking the SEC to do a study and make a determination of where that pricing should be, and it doesn't really require a real trade at, if you will, provision. So the real concern with all of this is if you widen spreads, and then as you mentioned the CFA study, do you simply push more order flow in the dark? And if you were to unleash that today, absolutely that would be the case. So the small investor, the retail investor, is going to be totally disadvantaged by this, and there's no real indication that there's going to be more liquidity in the market. By forcing that price improvement level, so what trade at means is if you're going to trade on an internalized basis, you have to do so by a meaningful level. So by forcing that at a real number, and maybe if the spread is a nickel, you say it's 2.5 cents at the midpoint or in the middle of the bid and the offer, then that would be a reasonable place before you internalize.
And all your
that are real.
Yeah, all you're trying to do there is like encourage the liquidity provider, because that's, like our firm at Bright Trading, I get this all the time. I was talking to a trader yesterday and he's sitting on the bid and he says, I can't get down on my order. I'm trading some small cap stock. I've been on the bid for 4 hours here. It keeps trading at my price or right in front of my price and I can't get filled on the thing. And it's such a frustrating thing as a trader, a limit order trader, to have your limit order sit there, look at the consolidated tape, look at it trade, for a sub penny above your price and not get filled. I don't think it's much of an issue, on like a Johnson & Johnson or stock that's trading at a penny, because you can just pay out the penny. But if you're trading some of these small caps, they got a 50-cent spread. Who wants to pay a 50-cent spread? So in essence, what these internalizers are kind of doing is forcing you to pay the spread. So, and it really discourages liquidity.
Yeah, kind of doing? No, that's totally happening. I mean, when you put a limit order out there, how many times have you seen as a trader that your limit order is essentially being used as a backstop, and then you see all these prints going up 6 decimal places and a penny in front of your limit order while you're not getting filled? In a tick size study like that, if you were just to widen spreads to a nickel, that would be exacerbated to a large degree.
Well, you're just widening the spread for the internalizer to make a bigger spread.
Yeah, but do you think that if I look at that, like really this whole problem got started when they went to pennies, and it was supposed to be better for the individual investor. But now you're enlarging a select group of institutions to trade at sub pennies. I mean, don't you think even if you made it eliminated that for a couple of these players, that it would really knock out some of the high frequency, because they'd actually have to step out a penny or two ahead of these orders instead of fractions of a penny?
Well, one thing I'd like to point out real quick is a lot of times people think that high frequency are the ones that are doing a lot of that subpenning. It's actually a lot of the internalizers.
Okay.
It's actually a lot of retail order flow that gets sent to the Knights, Citadels, UBSs of the world that's printed at those levels. The HFT firms are actually the ones, as Dave spoke about it earlier, they're most of the time ahead of you on the transparent limit order book. So I completely agree, this sub-penny price improvement or this sub-penny printing that's going on in the marketplace really needs to be stopped to a big degree. And that's something Dave and I are actually working on.
Okay, and you guys are working there at Core Trading here, and we do appreciate you guys obviously fighting for the little guy and fighting for the retail trader. Tell us a little bit about Core Trading there, Chris. Like, what do you got on the tap there?
Well, I'll let Dave kick it off with that.
Okay, sure.
Yeah. So, with Core, what Chris and I decided to do is basically, stand up and say, we see some problems, we see things that need to change, and we don't really see people working on it, especially not down in D.C. We see a very big presence in D.C., and it's all of the big banks, and increasingly this modern markets initiative as well. So we thought there's really a void there, and it needs to be filled. So Chris and I are focused on pushing rule changes and pushing modernization, as he was saying, of some of these regulatory issues that will increase transparency and that really focus on improving markets without sort of being beholden to a P&L and being beholden to any conflicts of interest. So, we sort of think we're unique in the market in terms of what's going on in the market structure debate. And then we're also available for consulting. We're doing workshops, market structure workshops, intro to high-frequency trading workshops, order routing and order flow, that type of thing, trying to spread the understanding that we have of markets as practitioners. And then finally, we have this informational service. So on our website, you can sign up and you can get monthly market structure reports, as well as all sorts of different analytics and visualizations of data such as market quality data, broker routing, and payment for order flow data. And then we're also tracking every filing from self-regulatory organizations, all the exchanges and FINRA, and summarizing them and commenting on them on the website and in the monthly report.
Well, thanks, Dave. It sounds like you guys are really doing a pretty good fight here for the little guy, and that's the whole thing. You go in Washington, and the big guys have all their money and all their power. We need more guys like you guys fighting for the little guy and fighting for fairness and fighting for a level playing field.
Right,
So,
right.
That's what we're trying to do, Dennis. Thanks.
Yep.
Okay.
And that's one of the interesting parts that Dave and I bring. Me coming from the retail background and Dave from the technology and high-frequency background really gives a lot of experience to help address a lot of these issues.
Okay, we've had Christopher Nagy and Dave Lauer of Core Group LLC just discussing, the inner workings of the market. You see a lot of things going on. These guys are studying the markets and sticking up for the retail trader. As we say, Grandma, did they get that Grandma from me? I say the little old lady from Pasadena. I wonder if they stole it from me. But Chris and Dave, thanks a lot for your input on this, I guess you could call it a controversial subject, and we'd certainly like to have you on again.
Appreciate
thanks,
it.
guys. Thanks for having us on, and people can check out our website. It's kortrading.com.
kortrading.com. So, and if you get a chance, I don't know if you're on the site there, if you're in the chat or whatever, we've just wrote in the Core Trading there too in the chat. So if anybody from the chat's got any questions there, we can get them along to Chris and Dave too. Thanks a lot, guys.
Awesome. Thanks.
Thanks, guys. Bye.